This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
In chapters 16 and 17, where we were introduced to the corporation tax computation, we saw how it was that we would be able to prepare such a computation for each and every individual UK resident company. We then saw in chapter 18 what would happen if that company had, instead of sustaining profits, incurred a loss. That loss would probably be the main one, a trading loss, but there were other possibilities like a property business loss. We looked at the different loss reliefs that would be available. But in each of those chapters, what we were looking at then, was just a single individual UK resident company. A single company. As we can see here in chapter 22, we will be looking at groups of companies. Now, there will be good points and bad points about being within a group. We have rules and we have claims and elections that can be made, which we'll need, of course, to come to terms with. So first of all, some of the ground rules here. Good news to begin with, that when we deal with a group of companies, a concept you will be familiar with from your financial accounting studies indeed there, we know what a group is. There is a parent company and then there is a subsidiary, or there are subsidiary companies. To be a subsidiary, there must be more than 50% control there by the parent of the subsidiary company. And the first reassuring point is we don't have the problems that we have in financial accounting / financial reporting. We know that for accounting purposes, we will produce accounts for the individual company itself, and that all of the accounts of the group companies will be consolidated together. We'll have consolidated accounts. Well, fear not. When it comes to corporation tax, there will still be, and there will only be, a single corporation tax computation for each individual company. But the fact that it exists not alone, not in isolation, but as part of a group, depending on the exact group structure, that will be measured in percentage shareholding terms. There will be different rules, different claims, different elections that will be available. And what we've got to explore in terms of this chapter is what are the issues when dealing with that group of companies. First point, as we've made, is we don't have to worry about anything other than preparing for each individual company a normal corporate tax computation. But what is it about the fact that that company doesn't exist, as we've just said, in isolation, but is a part of a group? What opportunities, what problems does that bring to you? What rules do we have to apply? And what claims and elections might we choose to make? And if we have a claim or election available to a taxpayer, whether an individual or whether, as here, corporate, we're only going to make that claim if it improves in some way, shape or form the tax position of that taxpayer. Presumably, therefore, either reducing permanently the profits of the company so as to reduce its tax liability, or if we cannot reduce permanently, can we at least defer when a figure of profit may be chargeable to tax? So these now have to be explored, not just on an individual basis, as for example loss reliefs in chapter 18, but we now need to explore on a group-wide basis. As we've said, group companies will benefit from certain reliefs, but there's certain additional rules and regulations that will also be placed upon them. A group exists, of course, where one company is a subsidiary of another. The various reliefs and rules are only applicable to members of certain group structures. And those group structures are going to be measured in percentage shareholding terms. We'll have our basic bare minimum in terms of a group for a group company, and that is we'll have a 51% group. By 51% we mean the shareholding by the parent of the subsidiary exceeds 50%, so it has control. This goes by the term here, 51% groups. The rules that apply there and the issues that we've got to deal with are fairly limited, in all honesty. And two of the issues that come up here are actually issues that we've already confronted in earlier chapters, basically in chapter 16. I don't expect you to remember those, don't worry, but I'll be reminding you of them in just a few minutes' time. It's when we get to 75% groups that life gets a whole lot more interesting. And that basically comes down to looking at two key areas. In chapter 18, we looked at what would we do with losses. The main loss, a trading loss. What could we do with it within a single company? Well, it was fairly obvious. We could relieve that loss against other profits of the same accounting period. And if we did that, and only if we did that, we could then carry back that loss to a previous period, or indeed periods. It could be carried back a maximum of 12 months there. And if we do not want those reliefs, or after applying those reliefs, there's still some loss left over, then it was simply a matter of carrying it forward. In each case, we had to look at, well, when you relieve in those periods, whether current, whether previous, whether future, then what profit figures do we go against? Now, you had to know the makeup of your corporation tax computation to know what could be done and the reliefs that would be available going against a figure of total profits there. That's total profits, which may or may not be the same as the bottom line figure on the corporate tax computation, which is TTP, taxable total profit. So that loss, whether trading, whether property business loss, whether capital loss, was staying within that company. If we couldn't use it now, could it be carried back? Which in terms of trading it could. Otherwise it could be carried forward, which again with trading it could, as also with property business losses and also there with capital losses as well. What happens when we add into the mix the fact that the company that has experienced these losses doesn't exist in isolation, but is a member of a 75% group? Because group relief then comes into play. Now, group relief is probably the biggest area that we look at in this particular chapter. But in essence, the concept is very simple. We have two members of the same group. Now, let's just have a little diagram here of a very basic group structure. We have our favourite group of companies, the AV group of companies there, with obviously two subsidiaries, Company F and Company C. We have indeed AVFC is in terms of our particular group. Now then, what we have there is AV, the parent company, and two direct subsidiaries. And in both cases, the percentage shareholdings that AV has in its direct subsidiaries is at least 75%. So basically everything that we look at here in terms of groups is relevant for each of those three companies. We have a 75% group. What you have there is just direct subsidiaries. It can get more interesting, and what we may then have would be indirect subsidiaries. So we might have here two sub-subsidiaries, two indirect subs that go by the name of Clarets and Blues. That's the team colours, by the way. And we might have that F owns 90% of Clarets and C owns 70% of Blues. Now, clearly 70% is not 75%, and that's going to be an issue in terms of it's outside of the 75% group, so none of the issues that pertain to it, one of which a key issue is, and the main one is, the ability to group relieve losses. Blues would not be able to group relieve its losses or any of the other company's losses against its profits there. Blues would be outside of that 75% group structure. But for example, if F were to have made a loss, and again usually if there is a loss it's a trading loss, but if F made a trading loss, instead of only company F being able to utilise that in terms of a current period, a carry back, a carry forward claim, we have now a much more flexible area of loss relief known as group relief, the details of which we will see later in this chapter. But the basic idea is, if we've got a loss in F and we've got TTP, taxable total profits, in each of these other companies there. To be able to group relief, as we'll discover later, you've got to be in a 75% group, so that immediately means that Blues is out of this. But any of the other companies, as again we will review in detail later, with the specifics of why group relief is available, given the percentage shareholdings that you see there. But it would mean that we could take any part of a trading loss, and it usually is that one, we'll stick with that for the moment, any part of that trading loss made by company F, and choose to set it against the taxable total profits of the claimant companies that could be any of those other three possibilities. We could take the loss from F up to its parent company AV, across to its co-subsidiary, fellow subsidiary here, company C, or down to Clarence. Now that's quite a choice, not just current period carry back, carry forward, where there wasn't always a sort of flexible mixture of those. Those loss reliefs would go against all of total profits. And the only way that you got to carry back a loss was if you did make a loss relief claim in the current period against total profits and still had loss left over. And then it came backwards. Only when it went forward did you have any flexibility over how much of the carried forward loss would be used against the future total profits. Here with group relief, or a little later I should say, in group relief, we will see that any amount of that loss could go against any amount of the taxable total profit of those companies. Now that means it's a bigger choice. So we're now getting into higher skills. Your planning skills will be coming through here. It's not just a case of it's made a loss, these are the only things that can be done, and this is the order in which you do it. You would now have a choice here about if that company has the loss and the other three companies with whom we could group relieve the loss of company F all have profits, does it matter which of those companies you go to? Well, given that we have just a single corporate tax rate of 19%, then the corporate tax rate isn't changing. But what we will, in fact, we've mentioned this before, back in chapter 16, but don't worry, I'll take you all the way through it again, is that we'll have to look at, so why would you choose to use some or all of that loss against one company's profits, or use parts of that loss against maybe two or even the three other companies? What is it we're trying to achieve in terms of getting either a reduction in the amount of tax that we pay? We want to get that reduction as soon as possible. We like to claim relief at the earliest available opportunity. And of course, a further issue that will be most relevant here is if we have to pay tax, which sadly that's life, yep, companies, if they make profits, are going to have to pay tax. But if we have to pay tax, let us at least try to pay that within the rules, but as late as we possibly can, without incurring any penalties, any interest, any fines here. Let's pay it as late as possible. So we want to, first objective, reduce the amount of tax that has to be paid at any point in time, now, in the past, in the future. We want to be able to use that and reduce the tax liabilities. But any tax that still has to be paid, let's try and get a cash flow advantage by having to pay it later rather than sooner. And I'll remind you of that issue in a few minutes' time. So a big issue, the biggest issue in the chapter, and certainly in the context of 75% groups that we have here, is this issue about group relief of losses. Without going into any detail on it, the other issue is that they would then be said to be members of a chargeable gains group. And I say without going into any detail, In essence, it is a very simple system, and that is that if we go back to our AV group of companies, if we have companies that are again within, but as we will individually define for gains groups, a 75% group. If we're in that 75% group, then what does it mean in terms of capital gains? Once again, there will be issues about rules, and there'll be issue about claims elections that we can make. I'll just give you one glimpse of what will happen. That is, if we ended up with a net capital loss, by which I mean there may have only been one transaction, we sold at a loss, that's it. Or we had several disposals, some with gains, but we had more losses, so we had a net capital loss. In a single individual company, the only thing that you could do with that net capital loss, I hope you remember, is to carry it forward to set off against future net chargeable gains. So there'd be no immediate use for it. Well, guess what? If now we had a net capital loss in company AV, or indeed we just have a loss in company AV, then if we had a gain, or indeed gains here within company C, then what we would be able to do as members of the same gains group is to either move that loss, or as much of that loss as you wish to, over to the company with the capital gain. i.e., we wouldn't therefore have to carry forward that net capital loss, which would be the only option for a single company. Instead, we could use it now. We wouldn't want to end up with company AV having an unused loss this period and having to wait 1 year, 2 years, 5 years, however many years into the future, until it made another chargeable gain. Remember, companies will hopefully have trading income every year. They don't necessarily have capital gains every year. That could be once in the proverbial blue moon when they come along. So we don't have to wait around to carry forward that loss in anticipation or hope of a future chargeable gain that may or may not appear. And certainly we don't want to do that, where within the same group, in this accounting period, company C here has chargeable gains and is paying tax. So the logical thing you would like to be able to do is to use that capital loss or losses against this gain or gains. And you've got flexibility here, rather more than you might think. We can bring any amount of that loss across to set against the gain, or, not that it would seem at this point to make any difference, you could move any part of those gains and deem them to have been made by company AV, the one with the loss. So you can move the loss to the gain or the gain to the loss. Now, we don't refer to this as being group relief of capital losses. I know it sounds like that, moving a loss from one group member to another, like we moved a trading loss from one group member to another. That was group relief. But when it comes to capital losses, we don't talk about group relief. We have this claim here that can be made to deem that any part of a capital loss or a capital gain made by one gains group member may be deemed to have been made by any other gains group member or members. And clearly what I've demonstrated there, I hope to you, is the reason why you would take advantage of that particular election, where you have for the accounting period, the current period in question, we have a net capital loss in one company, net gains in another. We do not want to be paying tax on all those gains now and simply have to carry forward the loss to hopefully get some use of it in the future. We don't have to do that. And we have flexibility in as much as we can move any amount of loss from the loss-making company and put it in the gains in the company or companies making those gains, or we can move the gains into the loss-making company. Or we could move both the loss and the gain into a different gains group member. It has one objective: to match gains with losses. That's it. So the big issues in terms of this chapter are all to do with 75% groups, and they're to do with, as we've just explained, the ability that if in principle a trading loss, there's a couple of other examples which we'll see later in terms of group relief, but if you have a trading loss, the ability to shift any part of that loss out of the loss maker and put it against profits in any of the other claimant group companies. They have to be, as we'll discover, within an effective 75% group. We've also got to consider where there's more than one group company in question. How do we make that choice as to which of the group companies we would prioritise as being the one or ones that we would wish to firstly be able to take advantage of that loss? We then have gains group membership, where again, at this point anyway, once again, a similar theme: loss in one company, net gains in one or more of the other gains group member companies. We want to match the gains with the losses. We can do that by making that claim, making that election to deem any part of either the loss or the gain made by one gains group member to have been made by another. Now that's where all the planning skills come in. The ability for you to look at not just one corporate tax computation now, but potentially 2, 3, 4, 5, however many group companies there are, and be able to move things around from one corporate tax comp to another to improve the tax position for the group of companies itself. Now, the two big things, group relief of trading losses and the gains group membership, that is only possible where we have what we'll define specifically later, but you see illustrated here, if you can still see those percentages and those companies, within a 75% group. If we drop down a notch, like C only had 70% of blues, so blues could not be within a 75% group company, with any of the other members of the AV group of companies. If we drop it down to 51%, which of course we would have in the case of blues there, then we look at 51% groups issues. Now here there are 3, but 2 of these we already know about. I'll remind you of them, don't worry, but we already know about them. The third one we see later, because as yet we haven't reached chapter 25 that deals with VAT. But here under 51% group issues, related 51% group companies. We've seen this before. Where have we seen it before, I hear you ask? Well, here, back in chapter 16, to be precise, towards the bottom of page 99, we had that profits are defined as the TTP of the company plus dividends received, excluding dividends received from related 51% group companies. Related 51% group companies. Companies are related 51% group companies where one company controls another, or 2 or more companies are both 51% subsidiaries of another company. Dormant companies are excluded. And what this was all to do with was the size of the company, whether or not the company was large. And why did we need to know that? Again, I hope that you could remember at least some of the basic content of chapter 16. If not, you might want to pause now and go back and have a more careful look at this. But a company usually has to pay its CT liability 9 months and 1 day after the end of its accounting period. But, shall I tell you more about my but? I think I will. But large companies are required to make quarterly instalment payments to settle their corporation tax liability. This is not a good thing. You do not want to be making quarterly instalment payments. I hope you can recall that would mean instead of being able to wait until 9 months and 1 day after the end of the accounting period in question to pay any and all, indeed, of your corporation tax at that point. With quarterly instalment payments, obviously quarterly, there's 4 of them, but you would start to pay the corporation tax for the current period on the 14th day of the 7th month from the start of that accounting period. And then you'll make 3 further, 4 in total, quarterly instalment payments. You will be paying a whole lot sooner your corporation tax. Well, what do we just say in terms of what we would want to do from a planning perspective? How would we wish to help our corporate tax client? Job 1, can we reduce the amount of tax liability that they have to pay? Secondly, can we delay within the rules, without incurring penalties or fines, sticking to the rules, but our knowledge of those rules? Are we able to manage here the company or the companies so as to ensure that any tax that has to be paid can be paid at the latest possible date? And that would mean trying to avoid, if it were possible, making quarterly instalment payments. How would we be able to do that? All right, let's just go back to the note here. So one area is about related 51% group companies and ensuring we can recognise which companies are related, and then so what? What does it mean? What does it mean is in relation to who we define as a large company. And that was by reference to a profit limit of 1.5 million. But that profit limit of 1.5 million now, pardon me, now within a group of companies, we'd have to share that profit limit out amongst all of the companies within the 51% group. So the profit limit for use in any of the individual group companies needs to be divided by the number of related 51% group companies. So if you had parent company and 4 wholly owned subsidiaries, or at least 51% owned, parent, 4 subs, 1 parent, 5 companies. Each one, therefore, instead of having a profit limit for determining is it large or is it not large, instead of having a profit limit of 1.5 million, it would be 1.5 divide by 5. That's dropped down to £300,000. With that much lower profit limit, there's a much greater probability, therefore, that that company, one or more of those companies, may fall outside of that profit limit, above that profit limit, and therefore move into the quarterly instalment payment system. Is there anything we can do about that from a planning perspective? Group VAT registration, well, you don't know anything about VAT or VAT registration yet, but the concept is a pretty simple one, and we'll see it in chapter 25. That is, that for each company, that is, it also extends to unincorporated businesses as well. But here, each company would have to maintain normally its own VAT records, and it would have to submit its own VAT return. But guess what? Group VAT registration would allow not just in our group of parent company 4 wholly owned or 51% owned subs. It would mean that we don't necessarily have to submit 5 VAT returns for each relevant VAT return period. 1 for each company. We could bring them all together. If they're entitled, as they would be here in most circumstances, the detail is in chapter 25, to be in a group VAT registration, then that would mean we could have 1 group VAT return. Clearly that sounds a whole lot better in administrative terms as well. But that's chapter 25. Well, a little bit of chapter 25. Also, what we saw in chapter 16, the availability for capital allowance purposes of AIA. And that rule, as we'll see in these notes, there's only one AIA. We know we have an AIA limit, our annual investment allowance limit of £1 million. But you don't get that in each company. In the same way as we had to divide the profit limit of 1.5 million between all of these 51% group companies there, so too do we have to understand that only one lot of AIA is available, so £1 million in total, to be shared amongst the members of the 51% group. This time, however, you, the company, the group of companies, get to decide how you will divide up that 1 million. You won't simply divide it by the 5 companies in the group. You will decide how much AIA out of the £1 million limit. You will choose to say, right, you have this amount, you have that amount, you have that amount. There's 1 million in total. If the total qualifying expenditure amongst the 5 companies doesn't exceed 1 million, it's not a problem. Then all of those companies will have their entire AIA availability. But if the total expenditure is more than 1 million, pardon me again, if the total expenditure is more than 1 million, then we haven't got enough AIA available to go around. So we will get to choose, therefore, where would we rather have that 100% AIA, rather than, if we can't have it, what would remain? Well, it would just be WDA. If that's main pool, 18% writing down allowance on a reducing balance basis would replace 100% AIA available all now in this accounting period. So we get to choose where to claim the AIA. Again, if there's a basis for choice, you need to know it. We'll talk about that one again separately in a few moments' time. So we'll need to define our group in terms of 75% group membership, defining 75%, as we'll see later, firstly for group relief purposes, and secondly for capital gains group membership purposes. We'll also have to look at, well, obviously if it's 75%, you clearly are a member of the 51% group. But with our little group of companies that we saw here, we saw that in terms of blues, the holding that C, its parent, had in blues was only 70%. It's not 75%, but it is at least more than 50%. So blues is in a 51% group, at least with company C. We'll see later about the other companies as well, but at least with company C. And on that basis, therefore, the 51% group issues have to be considered. The 75% group issues are excluded from that particular company. So we will analyse our group of companies in the context of who's in the 75% group, who's in the 51% group, defining each of those groups in relation to the individual issue, whether it's group relief of losses, whether it's gains group membership, whether it's related 51% group companies, whether it's group VAT registration, or whether it's availability of AIA. First issue here, related 51% group companies there. Related 51% group companies. Now, again, back in chapter 16, we saw the definition. You may have paused the lecture yourself and gone back and had a look. But let's just remind you, first of all, the definition. Companies are related 51% group companies if one company is a 51% subsidiary of the other, or they are 51% subsidiaries of another company. Control. A company is a related 51% group company if the parent company owns directly or indirectly more than 50% of the share capital of the subsidiary company at the end of the previous accounting period. Dormant companies are excluded, but overseas companies are included. Again, you may get an objective testing question with a group structure shown, something like, well, without all the extra detail here, of ours there with AV, companies F and C, clarets and blues there. So we've got parent company, direct and indirect subsidiaries. And we have to define in the context of, here are related 51% group companies, how many related 51% group companies there are. Now then, if we go back to our group here, well, you have a think for a moment. Again, if I clear the decks in terms of some of the information here, and just go back to the basics that we had. Oops, we need that basic. 70%. We don't worry about losses and profits at this particular point in time now. So there we go. That makes it a little bit clearer, I hope. There we go. So there's the percentage share ownership that the parent company has in the direct subsidiaries and the direct have in the indirect subsidiaries. Using the definition that we have seen here and what we mean by control, I would like you to establish for the AV group of companies, if you assume for this purpose that what are the percentages I've given you have been the percentages at least since the end of the previous accounting period. These share ownerships have not changed for some considerable period of time. They were the share ownership figures not just during this period, but also at the end of the previous accounting period. There's been no change in those shareholdings. I would like you to establish how many related 51% group companies there are, and what does that mean then in the context of the profit limit that you will use for each company. And why do we care about the profit limit? Well, you need to answer that. Therefore, why do we care? What does it mean? What is it all about? Which, if you've been listening for the last 20 minutes or so, you will remember, I trust. So I'll just give you a couple of minutes to think through that and to look through that for yourself, applying it, as we've said there, to this situation in terms of the AV group of companies. Over to you, therefore, and I'll join you again in but a moment's time. Okay, so let's see if we've been able to correctly interpret, therefore, the significance of this particular section here, measuring what we mean by this control to determine whether companies are related 51% group companies for any given accounting period. And we were told here that it is a related 51% group company if the parent company owns directly or indirectly more than 50% of the share capital of the subsidiary company at the end of the previous accounting period. So, looking therefore at our little diagram of the AV group of companies, this is specifically an issue, to begin with, dealing with company Blues. Who is most definitely related? Well, company AV, of course, is related with its own direct subsidiaries. Its own direct subsidiaries. If they're subsidiaries, you own more than 50%. So, of course, they are related 51% group companies. So there's 3 companies so far. But we then got the indirect, the sub-subsidiaries. Now, this is where, as the note has just told us, we need effective 51% holding. So, 100% of 90%, 100%, I don't really need to write this out, but that would equal 90%. So the indirect holding from AV into Clarets is 90%. That is at least in excess of 50%, and therefore, yes, it's a related 51% group company. The next one, in terms of AV's link to Blues, 80% times 70% equals 56%. Again, we satisfy the rule in terms of the related 51% group companies. That effective shareholding held there by the principal parent company down to the indirect subsidiary is effective 51%, more than 50%. So what that means here, of course, is that all 5 companies are related 51% group companies in terms of the control level that company AV exerts over both its direct and then its indirect subsidiaries. The significance of that, of course, is 1.5 million profit limit, divide by 5 equals £300,000 profit limit to be used for each of these 5 companies. Now, that's a much lower number, 300,000 obviously, compared to 1.5 million. And the significance you can now see is that any of those companies that have those profits as defined, in excess of that £300,000 profit limit, it's going to be classified as large, and on that basis, therefore, may be treated in terms of the quarterly instalment payment system as having to make those quarterly instalment payments. Just because a company happens to be large this period doesn't necessarily mean that quarterly instalment payments will be necessary. But again, assuming that we have profit figures in each of these companies in excess of £300,000, then they may therefore have to make quarterly instalment payments. More of the details of that in the next chapter. What we have there is an assumption that the situation that you see in that little diagram was indeed the situation in terms of share ownership at the end of the previous accounting period. So you'd have to be told, of course, whether there has been any changes in the group structure during the current accounting period. We assumed here, for this purpose, that no, this is a constant situation that we've had for some time now, so it was definitely the situation at the end of the previous period, so there are 5 related 51% group companies. Any exam question that tests this specific issue, it's a clear area potentially for an objective testing question, is going to bring in some of these other more interesting circumstances, i.e. of a change in the group structure. So what would happen, therefore, in terms of our calculation, our revised calculation, if necessary, of that profit limit for each of our companies, if we had a situation where Claret's was bought during the accounting period and Blues was sold during the accounting period. If those two subsidiaries, a moment ago, if this was the percentage share ownership at the end of the previous period, both of them are to be included. But if we were told that Claret's was actually bought during this accounting period, well, if it was bought during this accounting period, we didn't own it at the end of the previous accounting period, and therefore Claret's would be excluded. If Blues was sold during the accounting period, even though we do not own it still at the end of this accounting period, we did own it at the end of the previous accounting period. So if it was sold, we would still include it for this period as one of our related 51% group companies. So there, as you can see, applying that rule, it means that if we sell a subsidiary during this accounting period, then we had owned it at the end of the previous period, we still include in setting the profit limit for this period. If we are talking about buying a new subsidiary during the current accounting period, then clearly we didn't own it at the end of the previous period, so it would be excluded. On that basis here, therefore, so far as our group are concerned, then the profit limits to be used for AV, for F, for C, and for Blues there, this now calculation of 1.5 million divide by the number of related 51% group companies, that would now be 4, and that would push up this figure from 300 as was to what, 375,000. Now that's the profit limit to use for AV, F, C and Blues. For Claret's, well, it's not likely to be an issue so far as any exam question is concerned for you, because it's likely to be tested in objective testing form, and that's going to be an issue of basically looking at the company AV specifically, what number of related 51% group companies are there for this period, or again, to take it a step further, what is the profit limit for this period? What you'd have to do if it were required, I don't see that being required in a single objective testing question, is in terms of Claret's, the one that was bought during this period, its profit limit will depend on where it came from. How many was it in a group? Presumably it may have been in a different group at the end of its previous accounting period. So its profit limit will be a function of the vendor group's group structure at the end of the previous period, not AV, the buying group's company's group structure during this period. So we need to know that. Again, it might have been the only subsidiary owned by a parent company at the end of its previous period. Parent, 1, plus the subsidiary itself, Clarets, 2. On that basis, divide by 2. It would be 750,000. So it is perfectly possible for different companies within the group to have different profit limits if there's been some sort of change in the group structure during this accounting period, i.e. we bought a subsidiary during this period. Doesn't affect the profit limit for the other companies within here, the AV group, but of course it will be an issue as regards who was it in a group with, how many related 51% group companies did it have, was it a part of, in presumably its previous group, if indeed the shareholder prior to this was a parent company rather than an individual. As I've just said to you, if it was the only subsidiary of a previous parent company, that was 2 of them related, and that will give a £750,000 profit limit. The relevance, of course, of which to determine the profit limit is to know then whether for any accounting period the company may be classified as large, and we then have to apply the rules that are applicable there to determine whether quarterly instalment payments would be required for this current accounting period. Okay, going back to our notes now. The other issues that we've got here, that's tested out that particular section there, but dormant companies are excluded. So if you'd been told that any one of those companies, those subsidiary companies to AV, had been a dormant company throughout this accounting period, then it would be excluded. We would not be adding it in terms of the number of related 51% group companies. But overseas companies are included. Now that's an odd one. If it's an overseas company, i.e. it is non-UK resident, as a non-UK resident company, it's not going to have a UK corporate tax computation. Its profits are not going to be subjected to UK tax. Not so far as our syllabus and our rules are concerned anyway here. Now, even though its profits would be outside the scope of the UK taxation system, the fact that this overseas company exists within the effective 51% group would mean that it impacts on the number of related 51% group companies for the UK group in determining the profit limits for each of those companies. So if we had an overseas company being included, so just going back to this for example, if Blues, instead of being Blues Limited, was Blues Inc., for example, a non-UK resident company, then even though it may or may not have been sold as well during the period, it was a related 51% group company at the end of the previous period. And even though it is non-UK resident, it's Blues Inc., not Blues Limited, it doesn't matter. We will still include those companies, those overseas subsidiaries will still be included as related 51% group companies. So dormant companies throughout the accounting period excluded. Overseas companies, yeah, even though they may not have a UK corporate tax computation to prepare, it does impact on the profit limit for all of the other UK resident companies within that particular group. The tax implications, as we've just discussed here, again, back to Chapter 16, if you haven't looked at it recently, it was about that profit limit of 1.5 used to determine if a company is large and is therefore required to make quarterly instalment payments is divided between the number of related 51% group companies. And there is a question for you to have a little practice on at home, please. The other issue, as we said, that we again came across in terms of Chapter 16 was, for capital allowance purposes, the availability of AIA. And as we see here, only one AIA is available to the group of companies, as we mentioned before, but the group companies can allocate the AIA in any way it chooses across the group if the qualifying expenditure is more than the AIA limit of £1 million. So The AII, easy for me to say, the AIA limit of 1 million does not relate to each individual company within the group, it relates to the group as a whole. If therefore there are 5 companies within the group for this purpose, it doesn't mean that each gets £200,000 worth of AIA. No, it doesn't. If you wanted to give all of the 1 million AIA to just one of those 5 companies, that's fine. You decide. You decide, and it will be decided, of course, based on, to begin with, the level of relevant capital expenditure that qualifies for AIA within each of those 5 companies. We, the group, can decide where we apply that AIA figure. Now, if the total expenditure of all companies do not exceed 1 million, we don't have a problem. Every penny that the group has spent in terms of qualifying expenditure for AIA will benefit from AIA. It's only an issue if that total spend exceeds that £1 million limit. There you get to choose. So a group, therefore, may choose to allocate the available AIA to firstly reduce the profits of large companies down to the relevant profit limit of the group company, and as always to special rate pool expenditure, I should say, as opposed to main pool expenditure. That issue we dealt with in Chapter 5. That is special rate pool expenditure. If you don't claim your AIA on it now, you'll only get a WDA of 6% going forward. And that, remember, is reducing balance. So that's a very, very small trickle of available allowances going over an infinite number of future accounting periods. Whereas main pool, you've got 18%. Now, it's still not a very big number in percentage terms, but it's a lot better than 6% there. So what we would do is to always allocate our available AIA to expenditure that would otherwise be classified as special rate pool expenditure. Then anything that is main pool after that, and if that takes us above the £1 million profit limit, then at least on the residue, we'll be able to claim 18% instead of only 6%. But what we're also mentioning there now, as we've just been talking about with this, the issue of related 51% group companies, is an objective that we would have is to try to ensure that companies do not have to make quarterly instalment payments. So what we've said here is we allocate the available AIA to firstly reduce the profits of large companies down to the relevant profit limit. So if we had, as we started with in terms of our AV group, if we had 5 companies who were related 51% group companies for this period, that created a profit limit that was £300,000. So before taking account of which company's expenditure on plant and machinery will attract AIA, if you have got a company in the group that has a profit figure prior to allocating AIA, so prior to the capital allowances, of say £500,000, then 500 exceeds 300,000. If it has got £200,000 plus of qualifying AIA expenditure, then if you allocate the AIA to this company, then that will bring it down in terms of its profit figure from 500 to 300. Therefore, what would have been large is no longer large. And that rules out the possibility or requirement to make quarterly instalment payments this period or indeed next period. Because if the company is not large this period, then whatever the estimate for next period will make no difference. It won't be large next period either. So on that basis, an issue where we have to take account of, so okay, I've got therefore this expenditure in terms of plant and machinery. Where do I want my AIA? Where would I prefer to have it? Or am I okay with a reduced figure of just writing down allowance? if I am able, through allocating AIA to a company which has, say, got a profit of 500,000, to bring that profit down, what do capital allowances do? They reduce the trading income, and therefore with it they reduce your TTP, and with it your profit figure. If I can bring that down to £300,000 by the correct allocation of the overall £1 million AIA, give 200,000 to this particular company, or whatever is needed to get total capital allowances to £200,000 plus, then what was 500 becomes 300 or less, and that means we remove any issue of quarterly instalment payments, both for this period and indeed for the next period. That's got to be a good idea. So again, a particular planning issue as regards, okay, so you can split that AIA limit of 1 million any way you like, but what does it mean? How do I make that choice? There's a main reason why you would favour one particular company over another if it can be brought down from being large to not being large, and therefore avoid the quarterly instalment payment system. Obviously, what can also happen with capital allowances, they reduce trading income. Trading income may be a trading loss. This therefore would increase a loss. Or, if the number's that big, we may turn what was a small trading profit into a trading loss. What then could that company do with that loss? Would we be able to carry that loss back, for example, and gain a repayment of tax from a previous period? So there are interesting planning points. Don't worry, any exam question you get at this level is not going to be that interesting, it's not going to be that complicated. But these are the issues that we would be looking to deal with. Okay, I want you to, as I've just said, have a go at example 1 there between now and next time and review through the issues that we've said. As you can see here, next time we start with the big one in terms of this chapter, which is the availability and application of group relief. Now, I've spoken about group relief already in this lecture. Go back again before you go to the next lecture. Don't just click start on the next lecture now. Go back and listen again to what I said about group relief. Because that, again, will be, I'll review through, but I'll expect you to know what I have already said, so I don't have to repeat it in detail in that next lecture. So revise what I've said on group relief, and we'll pick up on this particular section, this most important section of our study of groups next time.
This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.